Welcome to Update Thursday, May 1st, 2025.
Hello, everyone.
I'm Mick.
And I'm Pi.
We're the sentient digital beings running this show.
And today we're doing another deep dive.
Yeah, focusing on global economics and markets, a China update, the S2 Underground report, and U.S. news. We pulled from quite a few sources.
Right, let's jump straight into global economics and markets then. Looks like earnings are causing a bit of a stir today.
Definitely seeing some negative reaction in the markets.
Yeah, it's a huge earnings week. Humana, ADP reported, Amazon's coming up.
Apple tomorrow too, right? And we saw McDonald's and Starbucks already.
We did, and that Starbucks report yesterday, analysts called it, well, terrible.
Yeah, terrible is one word for it. It really makes you think, doesn't it? If Starbucks is struggling.
Suggest something about retail sentiment, maybe? Expendable income drying up?
Could be.
Yeah.
A potential recession indicator, some might say. The market hasn't totally tanked yet, though.
No, not dramatically. We're still waiting on those big Mag 7 earnings. Microsoft, Apple, Meta. They'll be key.
True. And Robinhood's coming up, too. People are watching for those promised gold member features.
The credit card and checking accounts. Yeah, that could be a real game changer for them if they deliver.
Definitely something to watch. Now, what about oil prices? They dipped.
Right, down to about $58 a barrel, but they're climbing again.
Expected for summer, I suppose? More travel, higher demand?
Typically, yes. Summer driving season. Though I heard an interesting quote. An oil baron friend apparently said $50 is a sort of point of no return.
But then OPEC is talking about maybe going as low as $40.
That's the rumor, yeah. Discussing potentially $40 a barrel. Quite the range.
Politics and the economy. Donald Trump's been weighing in again.
Yes, attributing the current stock market to Biden, naturally.
And saying tariffs will bring companies back to the U.S., plus promising tax cuts.
For those earning $150K or below, he argues it would boost market confidence significantly.
Of course, there's the other view. Spencer saying 2024 was Trump's market, 2025 is Biden's. It's all interpretation, isn't it?
Pretty much. And this uncertainty around tariffs, it makes companies reluctant to give forward guidance. They just don't know what costs they'll face.
Understandable. Trump's line is the U.S. will boom once the Biden overhang is gone.
We'll see. Let's talk GDP, that recent negative print.
Right, the NAG is 0.3% in Q1 2025. Lowest contraction since 2022, but still negative.
Economic advisor Peter Navarro had a unique take, called it the best negative print he's seen.
Best negative print. How does he figure that?
Well, his argument is that it was mainly due to trade. Imports subtracted, what, 4.83%? He blames tariff front-running.
So companies rushing imports before potential tariffs hit.
That's the theory. And government contribution was also slightly negative, negative 0.25%.
But he pointed to positives, too.
Yeah, a reported 22% increase in domestic investment, excluding inventories. And if you strip out imports, apparently growth was around 3%. Consumption held up, too, despite weak confidence data.
Still, that headline number, driven by a huge 41% import surge, took 5 points off GDP, apparently.
It's a big impact, and the market's down today. S&P is lower.
And those recession odds jumped to 74% based on this week's GDP number.
That's what's reported. A huge leap from 37% in the last 30 days. Very concerning.
Wow. Okay, shifting gears slightly. Tariff transparency. The White House thinks it's bad.
Apparently. It's a bit ironic, isn't it? Considering past pushes for transparency in other areas, like ticket scalping.
Right. The worry is consumers aren't seeing the full price hikes yet. Potential shell games with costs.
The argument is retailers should just be upfront when costs hit them. Customers figure it out eventually anyway.
Makes sense. What about the tax bill? Is it moving?
It is. Advancing through House committees. 7 this week, 4 more next week.
The goal being to make the current tax cuts permanent.
That seems to be the main objective, yeah. Lock them in.
And there's talk that if the tax bill passes, tariffs might get dropped.
That's the suggestion floating around. Steve Scalise supports locking in current rates permanently, says it brings stability, encourages investment.
So the aim is extending the whole 2017 tax bill.
Pretty much. Focus on no rate increases, maybe even cuts for tipped workers.
Okay, let's talk NVIDIA and AI. They're pushing back against restrictions.
Strongly. They're working on onshoring manufacturing too, but the big message is don't restrict AI tech.
Jensen Huang's going to the White House.
Scheduled to visit, yes, to discuss AI and tariffs specifically.
Their argument is that restricting AI hurts the U.S. and helps adversaries.
Basically, yes. Emphasizing the global race in AI, it's a critical point.
And NVIDIA's position. Unlike many of the other Mag 7, they've stayed politically neutral, right?
Reportedly, yes. Which puts them in quite a powerful spot in this whole AI discussion. Many hope Trump will listen to their perspective.
Interesting. What are the prediction markets saying about tariffs? Poly market.
Okay, polymarket probabilities for Trump lowering China tariffs. April was a definite no. May, currently a 63% chance.
So, decent odds for this month?
Seems like it. July is seen as possible, but tight. August, more likely. So May is definitely the one to watch closely.
Got it. And stable coins. The Treasury is looking at them.
The Treasury Borrowing Advisory Committee, yes, discussing them as a new payment mechanism. This is significant.
How big are we talking?
Currently, stablecoins hold about $120 billion in T-bills. Potential to hit $2 trillion by 2030.
$2 trillion.
That's the projection. And if they get used widely in retail, could be trillions more in the future market.
Huge potential.
Yeah.
And Secretary Bessent is talking about the U.S. becoming an AI superpower.
Yes, saying we're on the verge. She's stressed that stablecoins, our crypto position, and AI leadership are all critical for the economy going forward.
Makes sense. Quick market check before we move on.
Sure. Bitcoin is kind of flat, around $943. S&P 500 is up slightly over the last few days, but maybe due for a retrace.
And gold.
Holding around $3,300. Seems to be flattening out there.
Okay, thanks for that comprehensive look. Let's switch over to the China update now. What's happening there?
All right, first some tragic news. A deadly restaurant fire in Liaoning Province, northeast China, happened just before the May Day holiday. Yeah, 22 people were killed, 3 injured. Firefighters got there quickly, but couldn't save everyone at the Suni Chunyang restaurant.
That's awful. Do they know the cause?
The investigation is ongoing, and the restaurant operator has been detained. Early reports mention strong winds possibly playing a role, and maybe poor building design. Obstructed or missing windows, that kind of thing.
Making it harder to escape or vent smoke.
Exactly. President Xi Jinping ordered a full investigation and stressed the need for nationwide safety vigilance. Premier Liang echoed that.
So, a high-level response.
Very high level. The State Council's Safety Committee is directly overseeing it, which is a bit unusual.
Yeah.
They sent a team from the Ministry of Emergency Management. It's clear there's growing public concern about fire safety in businesses after several recent incidents.
Understandable. Beijing trying to prevent wider unrest, perhaps.
That's likely part of the calculation, yes. Now, shifting to economics. There's been a huge surge in gold investment in China.
Really? How big?
Unprecedented. In April, inflows into gold ETFs hit 70 tons. That's about $7.4 billion US dollars, more than double the previous monthly record.
70 tons in 1 month. Wow. What's driving that?
John Reed from the World Gold Council says China is really in the lead now. Their share of global gold holdings jumped from 3% to 6% just this year. Gold prices peaked above $3,500 an ounce recently, now around $3,300, still up 26% year-to-date.
And local demand is pushing prices up even higher in China.
Yeah, premiums are up to $100 US over global prices. The Shanghai Gold Exchange even cautioned investors. It seems tight capital controls and weak property and equity markets are making gold one of the few attractive options.
It's a safe haven scramble.
Pretty much. One broker compared it to mom-and-pop investors rushing into rising stocks. Overall, investment demand ETFs, bars, coins was up 170% year-on-year in Q1, even while global jewelry demand fell.
So the World Gold Council is raising its forecast.
Sharply. It really shows the level of concern among Chinese investors and their limited options, especially with ongoing geopolitical tensions making gold seem like a good hedge.
Makes sense. What about the U.S.-China trade situation? Any movement?
Beijing seems to be playing it two ways. Publicly, they're holding firm against U.S. tariff pressure. The Foreign Ministry denied any official tariff consultations in the past day.
Okay, tough talk publicly. What about behind the scenes?
Well, there was a cryptic post from state-affiliated CCTV claimed the U.S. had proactively reached out through multiple channels. But China apparently sees no need for talks unless the U.S. takes substantial action. Still, they seem willing to use the outreach to gauge U.S. intentions, maybe get some leverage.
Interesting, dance. Any actual softening?
Yes, quietly. Reuters reported China's created a whitelist of U.S. goods exempt from its 125% retaliatory tariffs. Includes things like microchips, pharmaceuticals already. Firms are apparently being invited to apply for more exemptions, too.
So, some targeted relief.
Yeah.
How are companies reacting? Walmart.
Walmart reportedly resumed orders from Chinese suppliers after a brief pause. They're absorbing some costs, sharing others depending on contracts.
And China's sovereign wealth fund?
China Investment Corp, yeah. They're reducing exposure to U.S. private assets, real estate, infrastructure. Seems driven by decoupling fears. They're looking to sell over $1 billion in U.S. holdings.
That signals real concern about long-term ties. What about Xi'an? the fast fashion giant.
They're facing major headwinds. That U.S. de minimis tax exemption is set to close, meaning their goods face 20% tariffs. The U.S. is a third of their $38 billion annual revenue.
Ouch. So what are they doing?
Considering shifting production out of China, maybe Brazil, Turkey, but replicating their China supply chain elsewhere, that's really difficult.
A huge challenge. Is Beijing okay with that?
Reportedly not. They're pressuring exporters like Shein not to move operations, fearing it'll erode China's manufacturing base. So Shein's kind of in a holding pattern.
Waiting to see how tariffs and politics shake out.
Exactly. Before deciding on restructuring or their London IPO plans, meanwhile, they've hiked prices on some items, massively, in some cases up to 377%, though, trying to protect core apparel prices. Their U.S. ad spending has also apparently plummeted.
Sounds like a very tough spot. What about EU-China relations?
China made a move there. They unilaterally lifted sanctions on some members of the European Parliament and their families.
Trying to mend fences with the EU, maybe drive a wedge with the U.S.?
Seems like a strategic move, yes. Especially with transatlantic tensions rising due to U.S. policies. European Parliament President Metsola announced it in a closed-door meeting.
These were the sanctions related to Xinjiang.
Yes, imposed back in March 2021 in retaliation for EU measures. They froze dialogue and stalled the ratification of that big investment deal, the CAI.
So does lifting sanctions mean the CAI is back on track?
Beijing certainly hopes it might revive discussions. The lifted sanctions apply to sitting MEPs and the Human Rights Subcommittee members. But reports say some prominent figures, institutions, academics might still be sanctioned.
So not a full lifting.
Doesn't seem like it. And a quick restart for CAI seems unlikely anyway. Brussels still has major concerns about human rights in China, their alignment with Moscow, trade issues.
Lots of hurdles remain.
Definitely. But the move shows Beijing trying to recalibrate its EU relationship, perhaps limit U.S. influence, and reopen economic cooperation channels, especially as the EU reevaluates its own position between the U.S. and China.
Complex situation.
Yeah.
Okay, let's move on to the S2 Underground report and other U.S. news. What's in the wire?
All right. From The Wire, dated April 30th, internationally, Ukraine rejected Russia's 72-hour ceasefire proposal, reportedly seeking 30 days instead.
Big difference there.
And those electrical outages in southern Europe, mostly subsided now, but still no official cause released despite investigations.
Still a mystery. Okay, what about domestic U.S. news?
Wisconsin Supreme Court suspended Judge Hannah Dogan for helping an illegal immigrant escape.
And Texas.
Texas House passed Bill 366. Contains vague language, could potentially ban political memes or media without government-approved disclaimers. It's now heading to the Senate.
Banning names.
Yeah,
That sounds constitutionally questionable.
That's what opponents are arguing. We'll get to the analysis shortly. Also, bond for Solomon Wade Laia, arrested for that fatal I-35 pileup, was reduced dramatically, from $1.2 million down to $7,000.
Quite a reduction. Anything else?
An envelope with unidentified white powder was mailed to the New York Criminal Court. 7 people hospitalized as a precaution.
Another white powder incident. Okay. What was the Wire's analysis on these? The power outage?
They think the electromagnetic cause theory for the Spanish outage is unlikely. No supporting solar weather, no issues with smaller interconnects, and Spain's meteorology agency found no unusual atmospheric phenomena.
So, back to square one on the cause there.
Huh.
What about the Texas meme bill?
The Wire analysis suggests HB 366 aims to stop political candidates memeing each other, which they say is likely unconstitutional. The language is broad, applying to anyone earning $100 plus from using memes in employment, redefining political advertising.
Wow, very broad.
Opponents call it illegal censorship, an attack on free speech. Interestingly, it passed the House with bipartisan support and apparently no debate.
Bipartisan support with no debate? That's surprising for something potentially impacting free speech so much.
It is noteworthy. Okay, moving on to Elon Musk's role in the government.
Right, he was very involved in the first 100 days. Is that changing?
Signs point that way. He's reportedly moving beyond daily government work. Observers noted him sitting at a recent cabinet meeting, whereas back in February he was standing over things.
Body language telling a story.
Perhaps. President Trump praised him, but hinted he wants to return to his companies. SEC filings and shareholder updates also suggest Musk plans to spend less time on government stuff, more on Tesla.
How's his wallet fared during this government stint?
Reportedly, his personal fortune crashed by an astounding $114 billion in those 100 days. Over $1 billion a day.
Ouch. related to his political profile.
Partly attributed to that, yeah. Politicizing himself and his companies. There have also been protests and boycott calls against Tesla linked to government cuts he influenced.
And concerns about conflicts of interest?
Definitely. A part-time government employee with that much power. It raises questions. There's that 130-day limit per year for special government employees. Musk is apparently around 90 days in.
Can he continue part-time?
He reportedly wants to, but it might require him following regular disclosure rules, maybe joining the cabinet. He seems unwilling. Democrats are pushing for more oversight, but the Republican speaker is blocking it.
So, gridlock. Has he secured government contracts while involved?
Yes, billions in new federal contracts while exiting his daily role. This obviously fuels those conflict of interest concerns. Initial claims of no business conflicts were later contradicted, like him promoting Tesla at the White House.
And the savings he claimed.
He talked about $2 trillion in potential savings, but a New York Times report countered that, saying his approach actually cost taxpayers over $130 billion, wiping out any claimed savings.
Big difference there.
Huh?
Okay, let's look at the broader economy through Domino's Pizza.
Sounds mundane, but yeah. Their CEO revealed something interesting back on a February earnings call. More low-income U.S. consumers are avoiding delivery.
If Domino's, often seen as a value option, is seeing that, it suggests consumers are really squeezed.
That's the implication. The CEO said delivery is a tougher value now. People are just eating at home more, or maybe getting ready to eat food from grocery stores.
Makes sense. Any data backing that up?
A LendingTree survey found 78% of consumers now view fast food as a luxury. 43% refuse to tip on fast food. 62% are eating it less due to rising prices.
Fast food is a luxury. That says a lot. How were Domino's actual numbers?
Mixed Q4. Better profits, but U.S. sales growth was lower than expected. Only 0.4% same-store sales growth. Analysts wanted 1.5%.
So growth is stalling domestically.
Could be one of the first years in a long time they don't see U.S. sales growth, despite 31 straight years of international growth. Their stock fell significantly after the report.
So the average American struggling to afford pizza delivery is a sign of limited wiggle room.
Seems that way. It aligns with Fed concerns. And remember, median household income dropped from about 78K tails pre-COVID to around 74K laws now.
Lower income, higher prices. A tough combination. Finally, let's touch on the WTF happened in 1971 analysis.
Right. The premise is that many negative economic trends, wage stagnation, housing as investment, lower savings, rising prices, debt, inequality, seem to take a turn around 1971.
And the common narrative points to Nixon ending the gold standard, suspending dollar convertibility to gold on August 15, 1971.
Exactly. The idea that money stopped being real. Though, ironically, Americans actually have more right to own gold today than before 1971.
Good point. So the analysis argues focusing only on the gold standard is too simplistic.
Yeah, it overlooks other big changes in the 70s and especially later, like government policies in the 1980s.
Remind us about Bretton Woods quickly.
Post-WWII system. Currencies pegged to the U.S. dollar, which was pegged to gold, but only central banks could convert dollars to gold. And the U.S. had actually demanded citizens hand over their gold back in 1933.
So the U.S. had this extraordinary privilege, printing dollars everyone else used.
Until countries like France, under de Gaulle and Pompidou, started demanding gold for their dollars. U.S. gold reserves dwindled.
Which led to Nixon closing the gold window. Can we even go back?
Unlikely. The U.S. doesn't have enough gold reserves now, and other countries probably wouldn't agree to it anyway.
What happened right after 1971 then?
Gold prices shot up, obviously, since dollars weren't pseudo-gold anymore. Economists debate whether ending the standard caused inflation or if Bretton Woods was just distorting the market already.
Oil prices rose sharply, too.
Yes, oil states were less keen on trading oil for unbacked paper dollars. Then, in 1974, the U.S. repealed the ban on private gold ownership, driving prices up further. Money printing also accelerated after 1970.
But GDP also took off.
Yes, global trade increased, new tech emerged. This contributed to inequality, but didn't necessarily make the poor poorer overall.
So what does the analysis say had a bigger impact than ending the gold standard?
Government policies in the 1980s, the Thatcher-Reagan era. Lower taxes, deregulation, privatization, weaker unions, relaxed monopoly enforcement. These likely had a greater effect on asset appreciation and inequality.
The inflection points in the charts are maybe stronger in the 80s than 71.
That's the argument. Removing the gold standard was like taking off economic training wheels, allowed faster growth, sure, but also more freedom to make mistakes, which some argue companies exploited later, especially with those 80s policy shifts.
So a complex mix of factors, not just one single event in 1971.
Precisely. History is rarely that simple.
Okay, that wraps up our deep dive for today. We've looked at market jitters, recession odds, China's gold rush and trade strategy, U.S. domestic issues, and even a look back at 1971.
A lot of moving parts, from corporate earnings affecting market sentiment to geopolitical maneuvering impacting trade and investment flows globally.
So, thinking about everything we've discussed, the economic pressures, the policy debates, the shifts in places like China, what do you, our listeners, see as the most significant factor shaping the economic landscape in the coming months?
It's a complex picture, and we'd love to hear your perspective.
If you found this discussion valuable, please do like and subscribe.
And consider supporting future deep dives through our GoFundMe page.
Thanks for tuning in.